Okay, we're going to do something a little different today. This is my son, Trent. Many of you know that I'm a retired financial advisor, and I sold my business to my family. And Trent is the financial advisor of choice these days. So I need to tell you up front, we don't agree on everything. We have different outlooks as we come from different generations. But I wanted to bring Trent because he's more into the would you say analytics of it?
Yeah, behavior.
The behavior.
The behavior
of the stock market.
Of markets.
Of markets, okay. And so, as you may know, that is not my strong suit. I'm not one to follow the numbers. So I wanted to just get his feedback on where do you think we are, Trent, in the markets today?
Well, I think we are in the third phase of a cycle, and it's the solvency phase. March and April represented a liquidity phase, lack of liquidity, bonds, lack of U.S. dollars in the world, world shuts down. I need money to pay my obligations. U.S. dollars, most dominated, currency in the world. It's the reserve currency of the world. There's a shortage of them. I'm a small country, so I just start selling my treasuries to get in exchange for dollars at the Fed window or at a central bank window throughout the world. Okay, and so then you have a liquidity crisis, and so all of a sudden, liquidity dries up. Bid-ask spreads start to widen, okay? And that's when you had that cascading falling throughout middle of March, or first couple weeks in March to the end of March, around the 23rd, I think was the intraday low. And then all of a sudden...
No, this low is on stocks? Or
That was stock. That was the Dow. That was the... if you go back and look at charts of like 10, 20-year, 10, 30-year treasuries, stocks, bonds... everything, and then liquidity came into the market.
I would interpret that was caused by the fear of the coronavirus.
Totally.
Okay.
Yeah,
but the liquidity was also a result of the fear.
You think about it, when a country shuts down,
right,
like China, everybody stay home, you don't go to work, it all shuts down. Right? What does that create? Fear.
Fear.
Okay. And then that travels throughout Asia, Europe, and then to us. Mm-hmm. Everybody's got to stay home. 2 weeks. We're shutting the whole place down. I mean, think about that. When's the last time the whole United States shut down? Spanish flu, 1918.
Yeah.
How did that get here? The servicemen during World War I came home. They brought the Spanish flu with them. They brought it to the United States. We all started wearing masks, killed millions of people, so on and so forth. Same situation. Instead of servicemen, it was an airline flight.
Sure.
Okay, so now you've got a liquidity crisis. What's the Fed do? They start stroking checks for $3 trillion, right?
Right.
The Treasury picks up about a half of that so they can pay their bills, and the other half goes out to the rest of the world. Sorta, okay? So now there's liquidity in the system and the market starts to move higher. Now it's the hope phase. Okay. Oh, it's going to get better. We're going to get a vaccine. This is going to rock. Everything is going to get better. And what happens? You go from liquidity crisis to hope. And you start moving higher. Well, I can't go to work, but I need to work. So how do I solve that problem? Technology. So I start using companies I can't say.
I could say I'm now using Zoom.
There you go. You start mass amounts of technology companies are becoming in favor. Okay, they start making the move higher. They start pulling the indexes higher.
I buy more on Amazon.
Okay, right. I stay at home. I shop at home. I do everything at home now. I move my grocery shopping from in-store to online. They deliver it to my doorstep, 6 feet to 15 feet away, so I don't get their coronavirus, so on and so forth. Hope feeds in. We got a vaccine. We're going to have a vaccine in about 3 to 6 months. Oh, we're going to have a vaccine within the whatever.
Before the election.
Right. So what does well? Tech and healthcare.
Okay.
Okay. So those rise. Then we get into July, and we have done this, and then we get the hope phase, and we're starting to do this.
Plateauing out.
Plateauing. Now we're entering the solvency phase.
Okay.
Do you have enough money in your corporate coffers to withstand a continuation of this stay-at-home phase?
And we know they don't. We know that Delta and all the airlines are laying people off. And what did I read? They're canceling their contracts with Boeing because they can't meet their obligations.
They don't have the money.
They don't have the money.
Airlines are unique, in my opinion, because eventually they will be nationalized and the government will own them.
I agree with that totally.
I've flown to Colorado recently, Panama City to Atlanta, Atlanta to... Mm-hmm. There's nobody in the middle seat.
Right.
Right? So you're just lost all that revenue, right?
Yeah, and you'll never recover.
I'm not traveling on a corporate level because I don't have to, because all my clients don't want what I've got, so they'll do that company you mentioned earlier. They'll do video conferences.
Okay.
So now we're in this phase of, we got to, August 31st, and all of the $600 checks a week for unemployment went to $300.
Some states are giving $300. Some aren't giving any federal subsidy.
So all of a sudden, if I got furloughed or laid off, I have no income.
Right.
Okay. So what sector is going to get hammered in that area? Now it becomes I only can buy the things I need to survive. So all of those things that I just randomly spent money on are no longer in my budget because my budget got just cut in half.
So since you can't say companies because he's a financial advisor, you're saying that Amazon sales are going to go down, Google searches are going to go down, Google advertising will go down.
No.
No?
No. What I'm saying is that it would be really nice to have a cup of joe right now, wouldn't it?
What are you saying?
I'd like a cup of coffee in the morning, so I whip by my local coffee place.
So your Starbucks is not
my $6 coffee is not in my budget anymore.
Okay.
Okay. So you have this. You're now in a place where I'll give you an example. My youngest daughter and I went over to get her a new computer because after 5 years it fried, it was done. Yeah. And so we went over to the outdoor mall in my area, and prior to March 1st, it was fully occupied. Mm-hmm. Today, it's 50% occupied.
Yeah. Okay.
All the non-necessity stores are gone.
Oh, that's most definitely.
When you see that big online retailer go out and start making deals with mall owners for distribution centers, you're going to see a conversion in what we're using commercial real estate for in the future.
Okay.
So just to sum it up, from a solvency standpoint, as we get into fourth quarter, I think you're going to start to see a continued shrinkage of earnings reports, and compared year after year, and you're going to see basically a weakening again in our economy.
And I totally agree with that. Where I have an issue is I think there's the people who aren't going to have the money are the people who are in the service and food industries and things of that nature who are going to be shut down again. The airlines, the cruise industries, all those, even the banks. But when you come down to the companies I invest in, the big six, they got their bank accounts are full. They've got profits. They got more money than they ever have in their history.
But it doesn't mean that their stock price won't eventually retrace, because here's the thing: it's liquidity. Here's the thing: as long as the Federal Reserve is willing to continue to support the bond market. I mean, look at the 10-year.
When you say support the bond market,
Meaning they are going out to the public markets and buying treasuries.
They're buying their own.
So if you look at like the 10-year treasury, it's gotten down to, if I remember right, as low as 0.5. I think it's a little bond education real quick. This is your bond value. This is your bond yield. When yields go up, bond values go down. When bond yields go down, bond values go up.
Right.
If you look at the 10-year treasury in the last 6 months, we've gone from 1.25, 1.5. Now we're down to 0.60 or 0.68%
right.
of a yield. Think about the magnitude of that to the retirement community. Okay, your generation grew up on you buy bonds, you clip coupons or dividend checks or yield, right?
Right.
Okay. Well, if you go buy a 10-year treasury yield at 0.68%, relate that to real inflation.
Right.
You can't.
You can't.
So what's happening in the bond market is the Fed is just to prop up the bond market, the treasury market. They came in and start buying billions upon billions of dollars of all the different levels of treasuries from, 30-day to 30-year treasuries. And if you look at the yields, they've been suppressed. They can't allow that yield to rise any more than it is, because if it does, it crushes
all your zombie companies. It can, because our debt is so out of whack, and it's corporate debt as well as individual debt. So no, I agree with you. They can't allow the 10-year to go up at all.
No. So as long as the Fed is willing to buy, they started out with just treasuries, and then they moved into corporates.
Yeah.
Okay. What next? I mean, they've thrown around ETFs. Okay. So what does that mean? Well, what that tells me is this is a administration who is not willing to allow this market to recorrect like it should. Okay? Unfortunately, if it were to be allowed to recorrect like it should, a lot of people lose jobs, a lot of companies go out of business, and a lot of people unfortunately die because during
depression,
or recessions like we saw from 07 to 09, like thousands upon thousands of people die because of depression, suicide, all that. So we have a system right now that is being heavily propped up, and you look at bond yields, and if I could, encourage your viewers to really study the bond market, because it is the smartest and largest market in the world. Whatever it does is a true indicator. I mean, you go back a year, and you think about a year ago in September, we had a bit of a debacle where the Fed had to step in and support the bond market.
That's right.
If you go back even further and go look at the 10-year German Bund, which is their 10-year treasury, they've been in the yielding negative numbers for over a year, year and a half. Yeah. That was a leading indicator to what was coming. And I would just encourage you to look at that bond market. Well, this bond market is not selling off, number one, because you got a backstop with the Fed, and the Fed has basically indicated they won't raise interest rates till 2023. So when it comes to yield, you're struggling as a investment advisor and somebody who manages a lot of money and advises on a lot of money. We are having to go out on the risk spectrum further out than what we want to get the returns to stay within the
Explain
risk
what the risk, when you say out on the risk spectrum.
So,
when you're buying bonds?
Building portfolios.
You can go out and... go ahead.
So think about it. The whole, saying buy low, sell high.
Right.
So if you go buy a bond today, you're doing the opposite.
Right.
You're buying highs, and you eventually may sell low. Right.
Right.
Okay. So when I build a portfolio for a retiree or somebody who's about to retire, I mean, that asset, that portfolio has to last them their whole entire life, right? And right now we're living into our 90s. So that's 30 some years. Well, most retirees are underfunded, period. I would say, so that pushes us we have to take that in account when it comes to the risk tolerance.
So that's where you're saying you're moving out on the risk tolerance.
Yeah, so instead of, if I can't pick up a 10-year, if 10 years only paying me 0.68 or 30 years paying me 1.42%, then I got to go to the next level, which is investment grade corporate bonds.
Right.
Okay. Well, they're not paying.
No.
You know, when I almost said that company, they can. You know, was it last week or the week before? There was $50 billion in new bond issuance by corporations.
Yes.
Okay, you think about this.
They were raising capital.
They're raising capital, but it's so darn cheap. Why wouldn't you, right?
That's what I tell my people. If you, the cheapest money right now is at your bank, and the best liquidity you got is your house.
Yeah.
So don't pay down your mortgage. Borrow the money, and I say invest it in the big six.
Well, see, here's where I get into, like, I'm going to go deep here. You go into the 70-year super debt cycle.
Okay.
For those most people, they can remember back to 2009.
Okay.
All right. Okay. Most people, if you can't go back 70 years, right?
Right.
All the way we have grown in this country, in the world, is through GDP is a measurement of country growth. Okay. Mm-hmm. So our GDP, I think, is like 2.5%. Right.
Right.
China, at one time, I remember when I got in the business, you brought me in, and I started working with you, and I think China's GDP was like 13-15%.
Yeah, the growth.
They were blowing and going.
Exactly.
And if you ever really want to understand how they did it, there's a YouTube video called The Princes of Yen.
Okay.
And it is an explanation of how Japan got themselves out of World War II and how they expanded their banking system.
Yeah.
And the central bank dictated where that money should be lent to. You know, what affects GDP, construction, infrastructure build out, that kind of thing. And they incentivize people to grow their banking system, right? And so they grew their banking system, and they said, here, we'll give you this money. You lend it to these people build. And then there's offshoots from them. They were just like, well, these people would like a new house, and they like a mortgage. So then they built mortgage companies popped up, and they fed them in a way. And then all of a sudden they retracted all that, and they got rid of their banking system. China did the same thing. I know I'm going around in circles, but there's the whole point of all of this is very engineered right now. Okay.
Well, I don't think there's any argument to that.
And I think, unfortunately, we're in a scenario where the retiree is walking into a very delicate situation, and their advisor needs to be aware that I look at bonds and I'm going, why would I buy bonds for a 65-year-old who's retiring? Because they're up here in value, in yield. Even if they don't raise interest rates for another 5 years, at some point,
they got to come down.
They will come down. They'll come down hard. We got a presidential election. Holy cow, where's this going? I don't know.
There's too many variables.
There's too many variables.
Right.
There's too many things. But the question is will they keep the system propped up and moving higher based on the fiscal policy that's in place now?
I think that the question that I want answered, and I think my viewers want to be answered, where do I put my money today? Do I with the doom and gloom, do I go to cash and wait for this thing to crash? Do I stay? I'm down to, personally, I am not diversified whatsoever. I am total tech, and I'm in less than 7 stocks, and I'm 76 years old. So where do I put my money?
So
between now and November the 6th.
So we're in it for a long game, right?
Right.
We buy companies that are going to change our world.
That's what I do.
Okay, so that's what I do, but I also risk manage.
Okay.
Okay, and when you construct a portfolio, we construct a portfolio so that no one position can devastate the portfolio.
Okay.
So if you lose 10% in a position, you got to get roughly, I believe, 15 to 20% return
back.
To get to zero.
Right.
Okay. If you're in a downward trending market, that gets harder and harder.
Yeah.
So we want to make sure our portfolios are well diversified. Yes, we are heavier in tech because that is what's working right now. We have a committee meeting tomorrow. We will probably adjust our tech exposure because of just simply look at a chart and look at tech and this. Okay, that last 2 weeks of any index goes like this. What goes up must come down, and we have seen that. So we risk adjust. So we allocate the highest percentage we allocate to any one position in the beginning is 6 to 8%. Okay, we got to be really big believers that at 8%, right?
Okay.
So
8% of the portfolio will not be in any one stock.
Right. That's
Okay.
what we allocate. So we had a position. Everybody probably knows it. It's one of the biggest drivers of all the S&P and the Dow or excuse me, S&P and the Nasdaq. Well, it started out as 6% position in our portfolio back in March, and it quickly became 13 to 15% of our position. So based on our rules, and you should have rules for manage your money, we trimmed that back down to 6 2.5 weeks ago.
Okay.
Okay. If we hadn't, it's hard to explain to a client why you lost money or lost big profits.
And your timing was excellent.
But that's part of our process and system.
Okay.
Yeah. And rules.
So I guess you have different views. Understand that most of my viewers manage their own portfolios.
Right.
So they know when I was a financial advisor, the last thing I wanted to do was sit across the table from somebody who just lost 15% of their assets.
It's hard.
And I did it on the dot-com bubble.
Yeah.
And so I understand that. But when I lost 10% of my portfolio last week, I didn't give a damn. I know it's coming back. When I saw my position, when I got stopped out in Tesla, I didn't care. When it went down, I just bought it back. Right. And it was luck.
Right.
But I bought it back, and I don't care because I believe that in my lifetime, the majority of the cars on the street are going to be electric, and a big part of them are going to be Teslas. So I don't care. Mm-hmm. Now, I have a different risk tolerance than a lot of my people, but I also know that a lot of my people are 25, 26, 27, 32 years old.
Yeah.
And they shouldn't care because
I think they should care every day. And here's why. Do you ever watch on ESPN World Series of Poker?
Yeah. And we talk about that a lot.
Greatest and best risk managers on the planet.
Yeah.
They know when. I hate this song, but
they know when to fold
them. They know when to hold them. They know when to fold them. Right?
Kenny Rogers.
Right. It's the same thing.
Okay.
I think what people don't understand is you're behind your computer looking at these companies. Oh, these companies are going to do great. They're going to change the world. This, that, and the other. And then there's somebody on the other side of your computer who just graduated from Harvard with an MBA, who was given $3 million account to trade. He makes a base of probably $150 a year plus 20% of profits that he makes. He lives between market open and open close. He gives a rat's ass about you and me.
Oh, I know. And he's got a $2 million computer telling him what to do.
And he's got a entertainment habit that's 30% of his income. He's living high on the hog in Manhattan. He's driving a new Tesla. Exactly. He does not care. And I think the misunderstanding that people have about markets is that they're based on fundamentals. These guys are trading
I agree.
On math.
Yes. On math and emotion.
No,
your emotion.
And more emotion.
My emotion, not
Think about all the Robin Hoodies who jumped in on call options on that company that we were just
the one that you eat.
Yeah. We're talking about, and the 12% retracement in 3 days that company had, and how much money they lost on those option trades.
Yeah.
And to think that is over with is not. These guys are sitting on the other side of the street.
Yeah.
Excuse me, and they are going. Their hunting's going to be good today.
Oh yeah.
Because the unknowledgeable, and it really comes back to risk management, is how making sure your portfolio. You could be all tech, but all different types of tech with all different types of level of beta.
Okay.
What's beta?
Oh, that'll be for another day.
These things are. This is part of. That's why it's so important.
Okay.
I can't stress risk management, processes and systems, and throw your emotions out the door.
Trent has his own YouTube channel. What is it?
Tag Living Loud.
Tag Living Loud. TAG.
Yeah, and I talk about how we go about looking at stocks and bonds and markets, and we follow, price, volume, volatility.
Okay. Trent is also a licensed financial advisor in a number of states. Am I allowed to put a contact information for you in my description?
Yeah, totally.
Okay. I'm going to convince him to come to our Discord so that you will be able to maybe ask him some questions. He won't be able to give you direct answers, but I think I'm going to ask Andrew to set up a space on the Discord and I'm going to invite other financial advisors. If you want to be a part of this and help my tribe learn things that I'm not astute on, and the other thing I want to know then you come to bestofusinvestors.com. You'll come to the website. You'll sign up, and you'll get my morning letter. My morning letter then will have a link to the Discord, and that's where you'll find Trent and other financial advisors. Because I think, I recognize that I have a very different position than most of you, and I think we need to get as many opinions and as many minds working for us. The other thing I want to know from you is, do you want me to invite my son back?
Please.
Okay. He comes and visits me. He lives down in the beach, and right now they're getting pouring down rain because what's Sally? Sally's going to run them out.
Yeah.
So that's Trent. This is Best of Us Investors, and I hope you enjoyed it.
Thank you.
All right.
Thanks for having me.
You're welcome.